to me, wallahi, I'll get you a job. You want money? I'll raise the money for you. No problem, I'll get you into uni. I'll do that for you. Get off the...
Hello guys, and welcome back to the Cedi Investor. So my favorite part of the year has finally started, and that is earnings season. If you're a new investor, earnings season is basically when companies start to release their earnings report or financial report, and it just gives you insights as an investor into the performance of a company. So I'm very excited to see how a lot of companies are performing, especially some of the companies in my watch list. So we'll go over that. Also, we'll go over how the Cedi Farm portfolio is currently performing. I'll show you how the portfolio is looking like. It's very exciting to see the growth of the portfolio since I started this channel. So I'm really excited to show you the past week performance. And finally, like I said, we are still in earnings season. So I think it is very interesting for me to showcase my watch list for the remainder of the year. We have a couple of companies that I'm very excited to see their financial reports. So at the end of the video, I'll go over my watch list, and you can comment down below what you think about it. I'll be very glad to know. So we have a lot to unpack in this particular episode. Let's get into it. So starting off with the earnings reports, like I said earlier, we have two companies. They are both banks, and they've released their financials for Q2. So let's start off with the comprehensive income. If you didn't do accounting or you have not been in the market for a very long time, this might be very difficult, but it gets easier. One thing that I always like to advise people on when it comes to investing, especially equity investing, is you have to put in the research. And that's why there's always alternatives. Not everyone is comfortable researching a particular company, going through their financials, seeing how it's performing, having a financial strategy. I wouldn't necessarily say it's a bad thing, but then if you don't have the time, I would rather advise you to invest into something different, like probably fixed income trade bills, or even into mutual funds where we have a fund manager or a professional analyst who is going to invest on your behalf. So we have those alternatives. So starting off with the statement of financial position, I can see that my public bank increased its net interest income. It went from 310 million to 357. So that's good. That's good to see. Net fees and commission income was relatively stable, a little bit less compared to last year, so not as good. But overall, we can see that their revenue, if you add the two, was better compared to last year. So they grew their revenue at a modest rate, and that's okay to see. Operating income too is the same case. It went from 422 to 491. So they are growing their revenues, their top line, and also being efficient when it comes to operating income, and I like that from them. When I look at profits before income tax as well, we can see that it also grew, and despite the expenditure increasing, I can probably see that it was at a modest rate. So even though they are growing their revenue, they are making sure that they grow their expenses at a modest rate or at a very slow rate, and I like that. And I like that about them. So basically, I'm not seeing anything wrong with their income statements. They are growing all their top lines and bottom line. We have their profits after tax also increasing. So that's very good to see. Now for the balance sheet, we also have cash positions going up. Overall, the total assets went up from 8 billion to 9 billion. Very, very good. I can see that loans and advances to customers, it grew at a modest rate too. One thing I always joke about with one of my friends is that banks in Ghana are not really risk savvy. So usually you see them investing a lot into securities rather than giving out loans, which I do disagree with, but I can understand their point. Their equity also increased from 900 to 1.1 billion. So I like that. It's good. So far, I've not seen anything that would be of concern to me. Now, looking at their cash flow statement, I think that's where I'm starting to see some issues that probably I don't like. The company made profit of 197 million, which is very good to see. But then, when you go through their cash flow statement, they are failing to translate that profit into actual cash for the business. I mean, if you even just oppose it to last year, they were able to generate about 907 million from the operating activities of the company. That's actual cash coming to the business. While this year they actually lost 23 million. So they are making profit, which is very good to see. But in order for you as a shareholder to benefit it, and that's maybe in terms of dividends payments or even reinvestment back into the business, I need to see that profits being translated into cash, real pure cash, which the business can then use for other purposes, like I said, reinvestment or dividend payment. So I think that's one red flag from them. So one red flag I also noticed was deposits from customers also went down. It went from 1.5 billion to about 112 million. So my hope is just for this quarter. I don't want to see it as a trend where deposits are reducing, because deposits is very crucial for the running of a bank. So I really want that to increase rather than decrease. Also, another thing that I saw was that they are paying down their debts, which is very, very good to see. You can see net cash generated from financial activities, that's payment of borrowings and payment of lease liabilities, all were negative, meaning they are paying. So it's very good to see. But I don't like that, especially when you have a negative operating cash flow. You made profit, but the net cash that you made from your business was negative. So if you have a negative cash flow and you are paying down debts, it's counterintuitive. I don't know if you guys get me. So so that's one thing that I noticed. Well, their cash position is still better than last year, but it looks like this quarter they burnt a lot of cash. They used a lot of cash, so hopefully I can see the benefits in other quarters. I don't want to see useless burning of cash without any impact of the business, if that makes sense. Lastly, let's go over the quantitative disclosures. We have the capital adequacy ratio. If you are new to investing and don't really understand, the ratio usually shows or indicates how financially sound the company how financially sound the bank is. So it was at 15.44 last year and 18.89. So very, very good to see. Also, non-performing loans actually went down, so they are being more efficient when it comes to the loans, but they also reduced their loan payment. Or did they? Let me check that. Did they reduce loan payments? Where's the statement of? Okay, the loans actually went up. So then that's very, very good. That they are being more efficient in terms of giving out loans, whilst they are also giving a lot more loans compared to the previous year. So that's good to see. The liquidity ratio is relatively the same. So it shows they have a lot of short-term assets, that is probably treasury bills, then cash on hand to pay their liabilities, that's their current liabilities. So that's very good to see. The leverage ratio is also going up from 5 to 9, so very, very good to see. I like that. All in all, I think Republic Bank's financial statement is quite okay. I don't think it's like anything exciting that will really push me into investing into them right now, but I can see that at least they are okay. They are growing their top line, their revenues are going up, they are keeping expenses at a modest rate. It's not really increasing at a fast rate. I like how efficient they are being with their loans. They are growing their capital adequacy ratio, earning more for their shareholders. One thing I said that stood out to me was their inefficiency when it came to trying to transfer or translate that profit into cash. I want to see businesses doing that. So maybe apart from that, everything else was quite good. Now next, let's go over Cow Bank's financial statements. It's also a bank, so it's quite interesting to see how Cow Bank is performing, and I can really just compare it to the performance of Republic Bank. So we have net interest income. It actually went down, not good to see. Net fees and commission income also went down. So even before I start my whole analysis of the company, I can really see that their top line, which is one of the most important things when it comes to my investing strategy, is suffering. They are failing to grow their revenue. Revenue for last year was way better at 384 compared to last year. So very not very great to see. Operating income was actually almost the same as last year, a little bit lower. I do like that they were efficient when it comes to the total operating expenses, but you do have to be efficient when it comes to that, especially when your revenues are actively reducing. So that's bad. Now, when you look at profits before tax, you can see that it's actually higher compared to last year, which shows that the company actually improved, but that's not really true. Like we said earlier, revenues, so it means actually money that they generated during that period in terms of revenue, the business actually suffered. And even when you look at the total operating expenditure, where I said, oh, okay, the company is actually being efficient with its expenditure, that's also not really true. It's because of net impairment gain on financial instruments, and that's basically money that was set aside to cover losses, which has now been brought back. So it could be because of a lot of factors that I don't want to go over right now, but we can see that even with the operating expenditure, something like personal expenses, like maybe salary and those things, it actually went up. Depreciation was relatively the same, same for finance costs, and they actually improved in terms of other expenditure. But you are paying more to your workers, which it might seem bad for me to say. I don't approve of, especially seeing the situation where the bank is. How are you increasing? The staff don't deserve more pay. The workers don't deserve more pay. And I know some people might think what I'm saying is controversial, but it's really not. The only way they made more profits compared to last year was because of the net impairment gain on last year's, that which was added to this statement, and that's what made the total operating expenditure even better. It should have been way more compared to last year, and with that, even the profit they made before tax was just relatively less. So I don't really approve of this. Earnings per share, we can even see, is still less compared to last year. That probably has to do with share price, but I'm not really impressed. I think Cowbank has to do way better. If the board running this company, I don't really see improvement, or they think they are not able to solve whatever issues they are in, they should be changed. They should be fired. I think this is really appalling, and I'm not really impressed at all. Let's look at the balance sheet right now. Cash also went down at this company. Cash went down 3 billion to now 2 billion, burning through cash. We don't know what they are using that for. Investments in security actually went up. Okay, so maybe that's what the cash was used for. Hopefully it does help the company. Loans went down massively. Hey, Cowbank, this was the same issue the bank faced. That's why I'm really shocked, because the main reason why they are in this situation was they heavily invested into securities compared to other banks. That's why when the government declared the domestic debt exchange program, they were the bank that suffered the most from it. And you're still repeating the same pattern. 3 billion going to 5 billion. Hopefully it works out. And they're not giving out loans. I know why they're not giving out loans, and we'll talk about that when we go through the quantitative disclosures, because their loans are inefficient. Let me calm down. Assets went God. Total assets went down from 10.9 billion to 10.6 billion. Liabilities went down a little, but God. Hey. Basically, this just means you as a shareholder, you literally own nothing of the company. You get 447 million in terms of shareholder equity. Those are going to increase. It means you've been diluted. The business is heavily reliant on debt. There is no form of capital from shareholders or equity that the shareholders are using to run the business. The business relies on solely debt, and if that debt is not used efficiently, then the business is just one click away from bankruptcy. That's just crazy. All right. Now, I don't even want to go through the cash flow statement. They didn't really make or generate any actual profit, so I don't think there's going to even be cash that's generated. You guys can download the statement and go through it. I'm getting sick of just watching this. Let's go through the regulatory quantitative disclosures. Capital adequacy ratio went up actually, that's good, but still way below Bank of Ghana's minimum. I think that's like 13.5 or something like that. They are going to be punished by Bank of Ghana. These people, non-performing loans 38 to 51.6%. Basically, half of the loans they are giving out are inefficient. People are not paying back those loans, or those loans are close to being defaulted. Very bad to see. Leverage ratio is also going down. Bad. And one thing that I'll probably want to note to you guys, maybe you think I'm being a little bit controversial, is this. A letter from Bank of Ghana to us indicated that the penalties associated with the breaches in capital adequacy ratio, single SOL, and aggregate forex opening position will be computed and deferred onto the bank's mixed profits, and its financial soundness indicators are within the regulatory limits. As of 30th June 2025, the bank was not in a position to quantify the potential penalties, if any. So basically, this company is saying that despite them reporting, despite them reporting 174 million as total comprehensive profits, they are not in a position to receive any potential penalties, which Bank of Ghana says they will receive after the company makes profits and is in financial soundness. So basically, it's just showcasing that they are not in profits. The profit they brought up was because of net impairment on financial instruments. So it's basically made up profit, and the company is not financially sound. So even though you can do a lot of models and say, oh, okay, investors are not looking at Cowbank might be very undervalued at 0.55. My brother, it is not undervalued. It is massively overvalued because of first concerns about the company. We don't know if the board are going to put in the measures to bring this company back from where it is right now. Hopefully that changes, and I pray that it changes. And I'm very, very sad for shareholders who are in this business right now, because they are suffering. They are just being diluted left, right, and center. They just transferred all their preference shares into ordinary shares, 1:1. So if you are ordinary shareholder, oh bre, you are suffering. But honestly, I'm really not impressed with their performance. So we have the Cedi fund currently still down 1.92%. We are negative, which is very, very it is what it is. I expect it to come or bounce back over the next few months. MTN, I think, was the main contributor to that. I'm still below my average purchase price. The current price is trading at 2.95, enterprise 2.85, and we have farm milk 4.1. So these are the companies in my in the Cedi farm portfolio. And lastly, like I said, I'll end off with my watch list for the end of the year. So I have GCB, EcoBank, Enterprise, and Farmwell. These are the companies I'm very excited to see their performance first of all, and depending on how they perform and other factors, I could be probably buying way more, or maybe holding or scaling back. But I'm very excited about these companies. These are their current share prices. I'll probably do another video where I show where the fair value of each of the company is, in terms of my assumptions. So basically, that's my watch list for the remainder of the year. Comment down below what you think about the two earnings reports. Cowbank has really sipped all the energy away from me, but I'm still excited to see how the other companies performed. Hopefully they performed way better. comment down below what you think about them. Comment down below what you think about my watch list, and also you can comment down below what your watch list are. What companies are you excited to see? And even, I think, comment down below what types of video you want me to do. I'll really appreciate that. Thank you so much for watching. Have a wonderful day.